In early February 2026, senior U.S. officials repeated that tariffs on Canadian imports could still rise as high as 100% if trade and China-related disputes were not resolved. No formal tariff notice was issued, no implementation date was set, no border procedures changed. USMCA trade continued as normal. To most observers, this sounded like familiar negotiating rhetoric. Strong language meant to extract concessions, not a policy shift that required immediate attention. Markets barely reacted. Trucks kept crossing the border. Supply chains did not visibly break. But inside corporate planning departments, something quietly changed. Contract language was adjusted. Investment timelines were reconsidered. Contingency clauses appeared where they had not existed before. Nothing dramatic happened that week. No crisis unfolded. No company announced a shutdown. Yet a core assumption underpinning North American trade, that extreme tariffs were politically unthinkable within USMCA, became less certain. The immediate consequence was not disruption, but hesitation. And hesitation inside an integrated economic system can matter long before any rule is actually enforced. At first glance, this looks like a story about tariffs. It isn't. Tariffs matter when they are imposed. This moment matters because they might be. Highly integrated trade systems do not run on daily policy decisions. They run on confidence about the future. Firms invest, hire, and build cross-border supply chains based on what they believe will remain stable 5 or 10 years from now, not on what happens this quarter. That is why repeated references to extreme tariff levels, even without legal follow-through, can carry weight. They signal that outcomes once considered off-limits are now imaginable. This is not about whether tariffs will happen tomorrow. It is about whether long-term assumptions can still be trusted. Most coverage focuses on the absence of action. No tariffs, no retaliation, no collapse. But that framing misses the quieter adjustment happening underneath. Companies do not wait for policy clarity. They prepare for uncertainty. When rules feel less reliable, firms shorten commitments. They hedge exposure. They delay irreversible decisions. Each choice is reasonable on its own. Together, they change how the system behaves. So the real story here is not trade enforcement. It is the cost of uncertainty becoming permanent. To understand what is happening, we need to name it. This phenomenon can be described as the USMCA confidence erosion cycle. The name matters because it shifts attention away from tariffs themselves and toward the mechanism that makes them powerful even when unused. USMCA is not just a legal agreement. It is a credibility framework. Its economic value comes from the shared belief that rules will remain predictable enough to justify deep integration. Factories spread across borders, components crossing multiple times, energy and food markets tightly linked. The confidence erosion cycle begins when that belief weakens. It does not start with enforcement, it starts with signaling. When extreme outcomes are repeatedly placed on the table, even rhetorically, firms begin to question whether long-term stability can be assumed. That doubt moves faster than policy. A useful metaphor here is a lease that hasn't changed, but might not be renewed. The apartment is the same, the rent hasn't risen yet, but you stop upgrading the furniture, you delay repairs, you avoid long-term commitments, not because you're moving tomorrow, but because you're no longer sure how long you'll stay. That is how integrated trade responds to uncertainty. The confidence erosion cycle works through adaptation. Companies adjust before they are forced to. Capital flows toward resilience rather than efficiency. Redundancy replaces optimization. None of this breaks trade, it reshapes it. And once those adaptations are made, they are rarely reversed quickly, even if tensions ease. What makes this cycle dangerous is that it does not require escalation to continue. It feeds on delay. Political leaders avoid decisive moves to prevent backlash. Markets interpret ambiguity as risk. Firms respond by hedging. Hedging raises costs. Higher costs increase political sensitivity. The system slowly moves to a higher cost equilibrium without a single dramatic moment. Nothing collapses, nothing explodes. Everything just becomes harder, slower, and more expensive. That is why this phenomenon is easy to underestimate, and why its consequences tend to appear long after the original signals are dismissed. Escalation in this system does not begin with action, it begins with expectation. In the early phase, very little appears to change. Trade under USMCA continues, trucks cross the border, factories operate, energy flows normally. To the outside world, the system looks intact. Headlines fade quickly because there is no enforcement to point to and no immediate disruption to measure. But inside the system, assumptions quietly shift. Companies stop treating extreme tariffs as impossible. They may still see them as unlikely, but no longer unthinkable. That distinction matters. Once an outcome is imaginable, it has to be planned for. Legal teams review exposure. Procurement teams add contingency language. Finance departments revisit long-term models. At this stage, escalation is contained. Firms describe their adjustments as temporary. Policymakers avoid clarifying signals to preserve flexibility. Markets treat the issue as noise rather than risk. The cost of uncertainty exists, but it is still absorbable. This is the moment where hesitation feels prudent. Over time, however, the system stops waiting for reassurance. Temporary precautions remain in place. Contracts roll over without returning to earlier assumptions. Capital expenditure plans are pushed back quarter by quarter, not canceled outright, but delayed enough to matter. Firms begin to design new investments around the idea that rules could change suddenly, even if they hope they won't. This is where escalation becomes structural. Cross-border integration no longer deepens, it plateaus. New projects favor locations that reduce exposure rather than maximize efficiency. Supply chains are rebalanced not because it is cheaper, but because it feels safer. Redundancy increases. Productivity growth slows at the margin. None of this triggers alarms. There is no shock to point to. But the cumulative effect begins to show up in data that is hard to connect back to trade rhetoric. Slower investment growth, slightly higher prices, weaker productivity gains. Political pressure starts to build. Businesses complain quietly about uncertainty. Workers notice slower wage growth. Consumers feel persistent cost pressure without a clear explanation. Governments face competing demands, reassure markets, protect jobs, avoid price spikes, and maintain negotiating leverage. At the same time, alliance dynamics complicate resolution. Canada seeks room to maneuver between U.S. pressure and its own domestic politics. U.S. leaders face institutional constraints and electoral considerations that make clear commitments risky. Neither side has strong incentives to force a decisive outcome, but neither can fully restore confidence either. Markets interpret this stalemate as information. Volatility rises modestly. Long-term planning becomes more cautious. Capital flows towards sectors and regions perceived as insulated from policy swings. Smaller firms with less ability to hedge absorb a disproportionate share of the cost. As months pass, the system internalizes the new baseline. Firms stop expecting a return to earlier levels of certainty. They train management to operate in a permanently ambiguous environment. Investment committees treat political risk as a fixed input rather than a temporary anomaly. This is not panic. It is adaptation. Adaptation, however, has consequences. Once supply chains are redesigned, they are not easily reassembled. Once investment is diverted, it does not automatically return. Once higher costs are passed through, they rarely come back down quickly. At this point, escalation no longer depends on new signals. Even if rhetoric softens, the system does not immediately respond. Trust, once reduced, takes time to rebuild. Firms wait for sustained reassurance across multiple cycles before reversing defensive decisions. Markets remain cautious. The longer ambiguity persists, the more the cost structure hardens. In the later phase, the effects become more visible. Trade still flows, but with less intensity and lower efficiency. North American integration remains in place legally, but economically it delivers fewer gains. Productivity growth lags. Inflation remains slightly higher than it would have been otherwise. Political debates grow sharper as voters feel pressure without a clear cause. Younger workers entering the labor market find fewer stable pathways in trade-exposed industries. Small businesses struggle to scale. Governments face weaker growth alongside higher expectations for support and protection. This is the stage where escalation feels unfair. No rule was officially broken, no treaty was abandoned, no tariff was imposed. Yet the outcome resembles a downgrade of the system. Eventually, some form of resolution becomes unavoidable. That resolution does not have to be dramatic. It could arrive through a comprehensive reaffirmation of USMCA stability, a renegotiated framework, or a broader geopolitical shift that changes incentives. But resolution, when it comes, does not restore the past. By then, expectations have changed. Contracts reflect caution. Investment patterns have shifted. The system has adapted to higher costs and lower trust. What makes this escalation ladder dangerous is that it does not rely on conflict. It relies on delay. Each step feels reasonable. Each decision is defensible. No actor needs to choose escalation. They only need to avoid clarity. In systems built on confidence, avoiding clarity is not neutral. It is a choice with cumulative consequences. And by the time those consequences are widely recognized, the ladder has already been climbed. Situations like this rarely feel historic while they are unfolding. They feel temporary, rhetorical, or unresolved. Yet history shows that trade systems often change shape long before formal rules change. A useful mirror appears during the final years of NAFTA between 2017 and 2019. Even before renegotiation terms were clear, repeated threats of withdrawal and extreme tariffs altered corporate behavior. Trade continued. Factories stayed open, but investment slowed, contracts shortened, and firms quietly prepared for outcomes they hoped would never arrive. The economic impact came not from what was signed, but from what was questioned. An older mirror comes from US-Japan trade tensions in the 1980s. Washington repeatedly raised the possibility of punitive measures against Japanese exports. In response, Japanese firms did not wait for enforcement. They relocated production, invested directly in the United States, and redesigned supply chains to reduce exposure. Those changes proved durable, even after tensions eased. Industrial geography shifted permanently, not because policy demanded it, but because uncertainty encouraged preemptive adaptation. A more distant mirror emerges from the early stages of the Smoot-Hawley era. Before sweeping tariffs were enacted, the debate itself unsettled expectations. Firms adjusted trade behavior in anticipation of disruption. When the law finally passed, much of the damage had already been set in motion by fear of what might come next. These parallels are useful but incomplete. In each case, the endpoint eventually became clear: renegotiation, relocation, or rupture. The current moment is different because it lacks a defined destination. There is no formal renegotiation underway, no clear break, and no resolution timeline. That open-endedness makes uncertainty more corrosive, not less. History suggests that systems rarely wait for clarity. They adapt first. And once adaptation becomes normal, returning to earlier levels of trust requires more than reassurance. It requires time, consistency, and credibility. For most people, this kind of escalation never feels like a trade dispute. It feels like pressure without a name. Middle-class households are often the first to notice it in prices rather than headlines. Cars, appliances, food products, and energy-related goods become a little more expensive over time, not because of shortages, but because moving and producing them carries more friction. Wages may rise, but not quite enough to offset the change. Budgets feel tighter, even when employment remains stable. For retirees, the effect is quieter, but more personal. Fixed incomes are sensitive to essentials. When everyday costs rise persistently, even modestly, confidence in long-term financial security weakens. Investment accounts may still grow, but purchasing power feels uncertain. Decisions about travel, downsizing, or helping family are delayed out of caution rather than fear. Small businesses experience the impact operationally. Input costs fluctuate. Shipping and compliance expenses become harder to predict. Margins thin. Owners hesitate to expand or hire even when demand exists. Many small firms rely on stable rules more than scale, and prolonged uncertainty erodes both confidence and cash flow. For future workers, especially those under 30, the consequences shape opportunity early. Entry-level wages struggle to keep pace with higher baseline costs. Career paths become less linear. Temporary contracts replace long-term ladders in trade-exposed industries. Saving for retirement is delayed, even as volatility makes early investing more important. Across all groups, the shared experience is compression, less room for error, shorter planning horizons, fewer clear signals about where opportunity lies. This is how systemic uncertainty becomes social experience, not through crisis, but through accumulation. The most unsettling aspect of this story is not what has happened. It is what has not. No tariff has been imposed. No agreement has been abandoned. No border has closed. And yet the system is already behaving differently. Trade continues, but with less confidence. Investment flows, but with more hesitation. Planning proceeds, but on shorter timelines. From the outside, the economy looks busy, even normal. Beneath that activity, trust has thinned. This is how higher costs become permanent without a single dramatic moment. Not because leaders choose disruption, not because collapse is inevitable, but because avoiding clarity often feels safer than forcing resolution. For a time, the danger is not that the system breaks. It is that it quietly downgrades, that it delivers less growth, fewer opportunities, and higher prices while still appearing intact. When the effects become obvious through slower job creation, higher living costs, and constrained choices, they will feel sudden, but they will not be new. They will be the result of small decisions made quietly, long before the consequences were widely felt. This is not a forecast. It is a pattern. And patterns matter because they show where attention should go before outcomes harden. If you want to understand how trade rules become expensive even when they don't change, how uncertainty reshapes economies without a crisis headline, this is where to look. Not at the announcements, not at the negotiations, but at the confidence underneath them. Because once that confidence erodes, rebuilding it takes far longer than losing it. If you want to keep following how these quiet shifts shape the world ahead, this conversation doesn't end here.